Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. As you all know, this is your Tax-Free Life podcast. This is episode number 75. So this is the 75th episode that we do in this podcast. And the title of this podcast is, Are You Wasting Your Standard Deduction? Now, obviously, we just went through tax season. So I did a lot of tax planning, not only for business clients, but also for individual clients. And by the way, before I forget, we're getting a lot of kudos and a lot of excellent feedback from the podcasts that we're providing on a weekly basis. So I would appreciate if you could help us by subscribing to our podcast and let your friends know. Let them know that we have a podcast that is totally geared toward maximizing your knowledge of financial items and topics that are going to be very, very helpful for the vast majority of us and the vast majority of you when it comes to your tax planning, your investment planning, your retirement planning, and then obviously living a tax-free retirement life. Again, today I want to spend a little bit of time discussing the fact that many Americans are wasting their standard deduction. And the reason why I know that is because in my firm we do tax preparation, we do payroll services, bookkeeping, tax planning, and most important, we do tax-free retirement planning. So every time that we engage a brand new client that comes to us, obviously we do a complete audit of their tax return for the last few years to determine where they're at in relation to their tax planning needs and goals and objectives. Normally we find that many a times a lot of these new clients that we engage are actually wasting their standard deduction. And the big question is that under the new Tax Cuts and Jobs Act that took effect for the 2018 tax year, which is the one that we just finished now in April of 2019. One of the things that we noticed, and we had already received some feedback from the IRS regarding this matter, that the vast majority of Americans were not going to be itemizing anymore. I think only about 25%. Now, we still have not seen the final numbers for the 2018 tax year, but perhaps only 25% to 30% of Americans would actually be itemizing as opposed to in previous years. The reason for that is that the standard deduction has pretty much doubled, regardless of, whether you're married filing jointly, you're single, you're head of household, you're married filing separate. So all of those deductions have actually doubled. So it's allowing more and more Americans to take the standard deduction as opposed to the itemized deduction. And again, as time goes on, at least, for the next 7 years, because all of these laws, or the vast majority of these laws under the TCJA, will actually sunset December 31st of 2025. The big question for all of us is, well, we now know when taxes are going to be higher in the future. Usually for the last 20, 30 years, we have been doing forecasts as to where taxes are going to be in the future. But, for the first time in many years, we now know. And when all of us wake up on January 1 of 2026, taxes are going to be a lot higher than they are today, meaning that the tax brackets that you're going to be forced to pay taxes on will be higher, and the standard deductions will be lower. And the reason for that is the new tax law sunsets in 2025, but January 1 of 2026, it goes back to the old law that was around in the 2017 tax year. So understanding and how to managing your tax bracket under the Tax Cuts and Jobs Act is going to be very, very important for all of us, at least for the next 7 years. And the better job you do in understanding how those deductions and brackets are actually working, then the better position you're going to be in order to maximize that opportunity and reduce your tax liabilities, not only now but also in the future, and most important for the rest of your life. So that is the importance of understanding the standard deduction under the TCJA. Now, obviously, when you take a look at the standard deduction, most people don't realize, everybody thinks that you start paying taxes at the 10% rate under the new law. So you go 10%, then you go 12%, then you go 22, 24, and so forth. But in reality, the standard deduction gives you a 0% tax bracket. So for the first time in history, the standard deduction, which is the one that provides for the 0% tax bracket, it's a lot higher than it's ever been. So it's good that all of us understand that. It's good that we pay attention as to what we're doing to our distribution throughout the year. If you work for a company and you have stocks or bonds or any investment that you want to sell, make sure you understand where you're at in relation to the standard deduction in your individual tax bracket. So you want to make certain that you don't go above the threshold. So therefore, that would put you in a higher tax bracket overall. If you happen to be self-employed or you own your own company, then obviously you have a little bit more leverage and you can do things in order to minimize your tax liability in 2019 from an accounting and from a tax perspective. Now, the next question is, understanding all of these things, the next issue would be, how to maximize your standard deduction in 2019 and beyond, at least for the next 7 years. First and foremost, again, we just went through the 2018 tax season, but the 2019 standard deductions are actually higher than the 2018 standard deductions. And the reason for that is that every year, or most years, but it's been happening every year since we've had all of these issues and concerns in the past. The standard deductions have been going up using some kind of an inflation formula that the government puts together from one year to the next. So for 2019, if you happen to be single, your standard deduction is going to go from $12,000 in 2018 to $12,200 for this 2019 tax year. If you're married, filing jointly, your standard deduction will go from $24,000 to $24,400. If you're married filing separate, it will go from $12,000 to $12,200, similar to the single standard deduction. And if you happen to be a head of household, then your standard deduction will go to $18,350. And the key here is that it's extremely important, and I cannot emphasize this enough to all of you that are listening to our podcast on a weekly basis, is that you need to know your numbers. Because you also have to know the difference between your itemized deductions versus your standard deduction. What do I mean by that? Well, let's say that, and most accountants are not going to do that. They're just going to plug in the numbers for the itemized deductions, and if the standard deduction is higher, they will assume your standard deduction and use that one. And vice versa, if your itemized deductions are higher, they're going to use that. But if your itemized deductions are lower, and I repeat, are lower than your standard deduction, you need to know what those itemized deduction amounts are. Because if you understand what they are, then you're going to be able to do some tax planning and offsetting in order to enhance, for instance, your retirement distribution planning in the future. And the reason for that is the following. If your itemized deductions are at $15,000, let's say $15,400 to make the numbers easier to understand, but your standard deduction is at $24,400. You have a $9,000 arbitrage between your itemized deductions and your standard deduction. If you don't do anything, then basically what you're doing is when you file your taxes, that $9,000 deduction is going to go to waste. It's going to go to waste, and you're not going to be able to utilize it. But one of the things that you would be doing is you would be leaving money on the table. Because one of the things that you could do is you can say, well, what if I have an IRA, and what happens if I'm past the age of 59 and a half and I am still working? If I have a $9,000 window of opportunity in which I am still within the standard deduction, what kind of numbers, can I do a Roth conversion in order to convert a portion of my IRA, which, by the way, or 401k to an IRA, which, by the way, when you put the money in those plans, you put the money in pre-tax. The money grew tax deferred, and you're expected to pay taxes on every single dollar that comes out of that account. But because of the fact that your itemized deductions are lower than your standard deduction, and you still have a level of buffering effect between your itemized deduction and your standard deduction, in this example, $9,000, then you can start converting some of your IRAs to a Roth IRA. And by doing so, as long as you do it carefully and you do it up to the standard deduction, then you would be offsetting that tax liability on that conversion and still be able to convert to a Roth, and that now have that money grow tax-free for the rest of your life. But it did not cost you any money to do that conversion because of the fact that you were underneath the standard deduction guidelines and you were able to maximize it. You would be surprised how many clients come to see us on an annual basis in which they have not been maximizing their standard deductions for many, many years. So these are things that are important for you to know, because at the end of the day, if you can take IRA money, convert it to a Roth, in which otherwise you would have had to pay the taxes on, and be able to do that conversion on a tax-preferred benefit, not only for you but also for your family for many, many years to come. Why would you not do so on an annual basis, and why would you not pay attention to it every single year before you file your taxes from a business perspective? See, the challenge that we have in America today is that I've been doing tax preparation for many years, but at the end of the day, most accountants are always looking in the rearview mirror of taxation. Very few accountants have the ability to do tax forward planning, and I'll talk about that in the next few minutes. But the vast majority, when you come to see them, you're going to bring them your W-2s and your 1099s and your expenses and so forth, and then they're going to plug that into their software, the accounting software program, and the accounting software program is going to determine whether you owe money, whether you broke even, or whether you're going to be receiving a refund. Very few accountants have the ability to do tax forward planning because they don't have the tax forward planning software necessary in order to understand the rules of engagement, in order to assist each and every one of their clients in minimizing their taxes, not only in the current year, but for many, many years to come. Now, in addition to that, most of them are not trained in tax planning techniques. And this is something that we do very, very well in our tax planning firm, which is Gables Tax Planning Group, LLC. Also, it's important that, closing the gap through Roth conversions, as I have just talked about, will provide you with what I would call a tax leveraged straddle, meaning that, you're able to do those conversions and pay no taxes whatsoever. Now, there may be times where it may very well make a lot of sense to do Roth conversions, even if you have to pay a little bit of taxes on that conversion. And the reason is that we're living in the third lowest tax bracket in the history of the United States, yet we have historically high debt. So we all understand that taxes in the future are going to have to be a lot higher, perhaps even double compared to what they are today. So let's say that you happen to be in the 12% tax bracket, and you have another $20,000 to $30,000 of additional income that you can report before you get to the 22% tax bracket. Well, why waste that income that you could have rolled over or do a Roth conversion on and report and just pay at the 12% tax bracket? Why waste it and leave it on the table? Because from a financial standpoint, you need to understand the tax buckets from a financial perspective, because that's going to allow you to truly enhance your retirement distribution planning. So if I can pull another $20,000 to $30,000 out of my IRAs and convert those to a Roth, so therefore I could enjoy tax-free income for the rest of my life and not have to worry about the required minimum distributions at age 70 and a half. Why wouldn't I want to do that? If I can stay at the 12% tax bracket in this example, and I can bring it up to the threshold between that 12% and that 22%, I would do that every single day of the week, because you're going to have to pay taxes at some point in time in the future. But if you have the ability to do it at a lower rate, then it becomes more like the old Midas commercial. Either you pay me now or you're going to pay me later. And if you're going to pay later, chances are you're going to pay at a much higher level than you would be paying today. So using tax leverage straddles are very, very important, especially under the Tax Cuts and Jobs Act, because at least you have a much greater and much higher standard deduction, and your tax brackets are lower than they were in the past. The other thing is, make sure you understand. Now, I know that most of you that have been listening to my podcast now, for at least a year, you have a pretty clear understanding of your taxable buckets, and that would be, the taxable bucket, the tax-deferred bucket, and the tax-free bucket. But it's important, especially in the world that we're living in today, in the tax world that we're living in today, that you get to understand it very well. Because at the end of the day, your taxable bucket, you're going to pay taxes on the growth of that bucket every single year. And the reason why it's a taxable bucket is because you're going to be receiving a 1099 from the institution where you have your money in, and then obviously you're going to have to come to someone like me and be able to report that as income and pay taxes based on your tax bracket. The tax-deferred bucket, most of us know, and that's where the vast majority of Americans have all of their money. Those would be your IRAs, your 401ks, your SEPs, your deferred compensation programs, your pension, all that income that would come out of that bracket. The money that you put in when in pre-tax, the money grew tax deferred, but when you pull that money out, you're supposed to pay taxes on the entire thing. Well, if you have ways now, because of the new tax laws, in which you can start doing Roth conversions out of that tax-deferred bucket and do so in a tax planning leveraged straddle perspective, in which you can definitely maximize that conversion without having to pay taxes. Or if you have to pay taxes, you're going to stay at the same tax bracket that you're in today, then that's going to give you the leverage to start moving that money to the tax-free bucket. Interesting enough, the vast majority of Americans have not been able to understand the tax-free bucket. And the reason for that is that information without education, as I always say, always leads to failure. And we Americans have a tendency to do a lot of reading. We go on the internet, we gather data and information, but again, we don't know what to do with that information. If all of us truly understood the impact of taxation and retirement, and we understood the leverage that we have today under the new tax law, we would want to continue to fill that tax-free bucket to as high level as we possibly can. Because at the end of the day, you have to keep the optimum balance between the taxable bucket, the tax-deferred bucket, and the tax-free bucket. And if you do so, then you're going to have a much, much better retirement life. You're going to have a life that is not going to have any susceptibilities to tax liabilities in the future, and you're going to be able to live a tax-free life, which should be the goal of each and every one of you on this call today. My final thoughts, obviously I didn't want to take a tremendous amount of your time today. My final thoughts is that you need to be able to understand your numbers. Now, I know you can all amend your tax returns, but most Americans seldom do any tax amendments after they file their taxes, for the given year. So I encourage all of you, if you're working with an accountant or you're working with a tax preparer, to make certain that you question them as to what things can they do for you from a tax planning perspective. Again, if you need some assistance, if you have any questions that you feel like are important for you to know and you want to reach out to me, feel free to do so. There's no cost or obligation to any of you to reach out to me and schedule a 20 or 30 minute call. We can do a video call, we can do a conference call, whatever is most convenient to you. You can always get a hold of me at area code 786-766-1042, or you can send me an email at Bert, B-E-R-T, @gablestaxgroup.com. And then obviously, as I always say in every single podcast, every single seminar that I conduct, every single webinar that I do for all of my clients and for all of you that are so precious to me and my firm, because you listen to us every single week, is that my goal is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks for giving me a few minutes of your time today, and I look forward to speaking to you next week again. Take care. Bye-bye.